Would you stand generally on the manipulation of the prices, though? Because when we talk about silver going forward, we cannot not talk about the banks and what they're doing right now, what they've been found guilty of basically doing. So where do you stand on that whole thing? How do you encompass that in your model?
So first thing I have to say, as far as what the banks have been found guilty of doing, there's a logical fallacy called the Mott and Bailey fallacy. A couple of them had traders that were criminally convicted with spoofing and front running, and essentially, cheating their flow clients by front running the order and scalping a few pennies off of them. So the Mott and Bailey fallacy is when there's kind of a switcheroo between something like that versus the real cash value. The premise that they're trying to argue for is that the price of gold would be thousands of dollars, if not tens of thousands of dollars higher than where it is, but for a long-term price suppression conspiracy. What they have criminally convicted traders at banks of doing is a front-running scam where, you say, I want to sell gold. So first they sell it, they short it, then they process your order, and you get a few pennies less than you would have gotten, and then they close their short position. That's certainly doesn't sound ethical if I understand what the banks have done, but that's not a mechanism for gold should be $20,000 an ounce, and the only reason why it's $1,900 an ounce is a suppression. So I probably have the distinction of being the guy who's written more than anybody to argue against the price suppression theory of gold and silver, and probably the most important piece that anybody should read if they want to get into this at a deeper level. I wrote something called Thoughtful Disagreement with Ted Butler. What I said in that piece is when two scientific theories are competing, what scientists have to do is they have to look for an edge case where the two theories would predict opposite behaviors. So what we have here is we have two theories. One theory is that the banks are selling paper naked short in order to manipulate the price down. And we have another theory. My theory is that the banks are performing arbitrage. And in fact, the basis that we calculate and publish every day for free on our website is the measure of how much profit you can make from this arbitrage. And this arbitrage is to buy spot metal, that is, buy metal bars at the offer price. So this is a realistic trade that one could put on, and simultaneously sell a futures contract against that metal on the bid price. So it's future bid minus spot offer is the basis. And then you can quote that as an annualized percentage. So you can compare it to interest rate products and say, yeah, I'd rather carry silver rather than buy a T-bill right now for the same maturity, because this is paying it's a better trade. And so in this theory, the banks are not naked, they're actually arbitraged. They have no net price exposure. Their exposure is to spread only. So, okay, those are two competing theories. Where do they predict opposite results, and can we measure it? And where they predict opposite results is at contract expiration. So, futures contracts are not, indefinite duration. Every futures contract has an expiry. And as you head into expiry, if the banks were naked, they would have to close with urgency. And to close a short position, you have to buy. And if they want to stay short, they would have to then sell the next contract forward. So right now, the March contract for silver is basically done. Anybody that didn't want to stand for delivery, or deliver would have by mid to late February would have closed their March position and opened May. So at this point, May is the active contract in silver. But a couple of weeks ago, we would have seen this action in silver. What if the banks were naked? They would have to be buying that contract with urgency. If the banks are arbitraged, they'd be perfectly happy to deliver. And maybe it's the longs who are speculators who are naked that have to close with urgency, which means they have to sell. So Monetary Metals developed this software platform based on my dissertation work and quite a bit of subsequent software work. We invested a lot of money in building this platform. We license what's called the tick history database from, it was originally Thomson Reuters, which has now been rebranded or spun out as Refinitiv. We have the tick history of every bid and offer in spot, gold and silver, and every futures contract going back to 1996 to sub-millisecond resolution. This is a database of terabytes. I mean, the amount of data, you don't just download it and start browsing it in Excel. So we had to build a whole big data platform to deal with this. And we're able to plot, and we show graphs in these articles of the behavior of every contract, 120 or 130 contracts as they expire, what the movement is, and whether it vindicates Ted Butler's theory, whether it vindicates Keith Weiner's theory. And I'll just leave that there as a cliffhanger for anybody who's interested. The article's for free on the website. Just Google Keith Weiner, Ted Butler, you'll come across it. Anyways, it's a scientific argument. I'm saying here's two theories that predict opposite outcomes in this Coiner case. Here's the data. Here's the argument. Judge for yourself. What I will say is that the article got a lot of play in all the usual quarters. GATA published it. Zero Hedge published it. Every gold site, Kitco, 24 Hour Gold. I mean, they all published it. I have not received to date a single serious or scientific response to it. I've definitely had a few curses and a few ad hominems. I have not had a single person respond and say your argument is wrong and here's why, or your data is wrong and here's why, or anything like that. So I'll just leave that there. I'm not in the world today to try to argue against manipulation anymore. I used to tilt at those windmills, and I think I learned what Don Quixote learned or should have learned in tilting at windmills. But since you asked, I figured I'd give that more extended explanation.
And I absolutely appreciate that, because whenever I get to talking to somebody in the comments or on Twitter about those topics, most of the times I'd say is that I am just not 100% convinced in what they say. You know what happened? Russia invaded Ukraine, and then gold went up a couple of percent, gold and silver went up a couple of percent, and then they dropped down again. And everybody's explanation for it, and that's something that I don't like. I don't like narrative after the price has already moved. It's easy to explain something that's already happened. You can make it sound whatever you want, and if your audience believes it and retweets it, and then that automatically becomes a truth, which is just not true. And so I have not been 100% convinced that that's the thing that's keeping the price of silver down. So there's other things that people say. People would say that when the suppression eventually ends, banks will start manipulating silver to the upside because they're going to take the opposite trade. What's your opinion on that one?
In general, the banks are in the business to make little spreads that, versus the retail, public that's reading this are trying to make big speculative gains or big capital gains, right? So the person who's buying silver at 25 thinking he's going to be selling it for 125, it's hard for him to kind of understand that a bank is buying it at 24.78 spot and selling it for 24.93 2 months in the future, that anybody would care. It's just pennies, right? But if you can borrow at a cost of, I don't know what banks are paying for 3 month money nowadays, but if you can borrow at a cost of 1% and then put on a trade that's earning 1.3%, and you can do that times $1 billion, you have a little business. And the bullion desks at the big banks are little businesses. They're a relatively small number of people, a handful or maybe a couple of dozen people in a large enterprise with 100 or 200,000 employees. And, it's a relatively small business, and they operate for small spreads. But with that small spread comes extreme not certainty, but a very high probability of success. Since they're not betting on price, they're just doing a spread trade. They only make pennies, but they make pennies every trade. And, Zero Hedge has written articles about, look at that, the bank had all of their trades winning for the entire month or something like that. Well, yeah, because this is a pretty simple trade that doesn't have a lot of ways that it could go wrong. It doesn't make a lot of money, per ounce. You just do a lot of ounces of it. You just lever up. Mm-hmm. So I think that, it's convenient and tempting in a certain sense to think, oh yeah, I own some silver, and silver is right now manipulated. It's so cheap. As soon as the manipulation breaks, this thing is going to violently snap to $200 an ounce or something like that. It's a lot of fun, and one can, go to sleep at night and, with pleasant dreams for that. But, to your point about these narratives and ultimately ideology versus trader mentality, if you're going to trade the markets, always have the discipline to ask yourself the question, not only what if my thesis is wrong, but what would have to happen in reality for me to see that my thesis is wrong? And if there isn't any, well, okay, then fine, you have great conviction, but maybe you're not trading anymore. And I talk about gold this way and say, okay, look, the dollar is going to fail, which in a certain sense means the price of gold will be infinite, but that doesn't mean it's going to happen tomorrow morning or next week. Let's keep in mind Keynes, who was generally wrong on almost everything he said, was right about one thing. The market can stay irrational longer than you can stay solvent. So it's not a trading thesis to say the dollar is going to fail. Yes, but the price of gold could drop from 1920 to 1820 in the meantime, and you're still right, the dollar will eventually fail. But you lost money on that trade, especially if you had leverage.
And so you decide to come on here today and just destroy people's dreams.
That's right. I'm just the dream and hope killer. No, I think that if you want to, play in the market, or if you want to solve a problem, which is really what I'm about, we have a monetary problem, I want to solve it. I think the first thing you have to do at the root is understand it. And if that trods on some pleasant fantasies, in a certain sense, I'm sorry, but in a certain sense, I'm not sorry. One has to get to the truth. The truth is its own, one pursues the truth for its own sake. Mm-hmm. And, if I'm wrong and it really is manipulated, then happy to hear that argument. And if I'm right and it's not manipulated, then yeah, I'm trotting on a few toes, but it is what it is.
You know how rare this is, right? For somebody who has a precious metals based business not to, because narrative is easy, right? And I'm not saying it's completely untrue or completely true. None of those. I'm just saying I personally, first of all, I'm not smart enough, even if I had all the information to analyze it and take a decision on it. But it's just rare. It happens a lot where you see people who own mining companies, who own different, or maybe have built an audience based on that whole mentality. It's just, it doesn't happen a lot where somebody comes out and talks about it that way. And while you're here and talking about that, I guess you wouldn't shy away from talking about the bear case on silver specifically, because that's what we've been talking about here. I guess you should come on another time if you enjoy this to talk about gold as well. But what do you think can work against the whole silver thesis generally? Like what are some of the bear cases that you're worried about?
I just want to touch on the point that you made. For a precious metals company to be talking this way is certainly going against the flow. And, I'm quite conscious of that. It'd be a lot easier to either say nothing or to just say, yeah, it's manipulated, it's going to go up. But I've never been able to just go with the flow. There's some gene in me that's just flipped the other way, I guess. The bear case for silver. So in this year's Outlook report, I said,